Welcome again. In this lesson we're going to talk about Chapter 3, which is a summary of financial ratios and forecasting. Key concepts and skills: knowing how to standardize financial statements for comparison purposes, knowing how to compute and interpret important financial ratios. You should be able to develop a financial plan using the percentage of sales approach, and you will have some of those on your homework as well as some variations. And understanding how capital structure and dividend policies affect a firm's ability to grow. The chapter is, I think if you have a text you can pretty well see how the chapter is outlined. First of all, standardizing financial statements. To standardize a balance sheet, we divide each line of the balance sheet by the top line. In other words, we take each account and divide by the amount of total assets. To standardize an income statement or make a common size income statement, again we divide each line on the income statement by the top line, which is generally revenue or sales. Standardized statements accomplish two things. First, they make it easier to compare financial information as the firm changes over time, as it changes in size and grows. Second, they're useful in comparing various firms in the same industry that have different sizes. Now we turn to ratio analysis, probably one of the most fundamental tools we have in financial analysis. Ratios allow for a better comparison through time or between companies. And when you're computing ratios, here's a list of things you should ask yourself. Basically 5 questions that you should be able to answer. I won't read them. Categories of financial ratios. We're going to discuss 5 different categories. The first is short-term solvency or liquidity. Basically a measure of how much risk the firm poses of default in the short term. Long-term solvency or financial leverage has to do with how much risk the firm poses in the long term because of debt. How well are we managing our assets? How efficiently are we operating? That's our profitability ratios. And finally, the valuation, which is our market value ratios. Price to earnings, price to book. So let's talk about each of these, starting with liquidity ratios. Probably the most prevalent liquidity ratio is the current ratio, which is defined as current assets divided by current liabilities. Some firms may exclude notes payable from current liabilities. Your book does not, and we will just stick with that convention. Generally, we're looking for a current ratio of 2 or higher, although it can vary and will vary from firm to firm. There is an example in your book. I'm not going to go through each of these, but as you go back through the PowerPoints, you can look at the spreadsheet, the balance sheet, and the income statement in your book, and you should try to calculate these ratios or at least see where the numbers come from. The next ratio is even a more severe test of how much risk we have, and that's the quick ratio. And here we exclude inventory from current assets. We exclude inventory because it is the least liquid of all of the current assets, leaving us with cash and accounts receivable. And finally, the most stringent test is the cash ratio, which just looks at the ratio of cash divided by current liabilities. And it would be a pretty unusual firm that has so much cash that it's able to cover its current liabilities for the coming year with just cash. Next, we look at the leverage ratios, which has to do, as I said earlier, with long-term risk. I might point out that if there's one thing that causes more firms to fail than any other single thing, it's excessive use of debt. So we're very interested in these leverage ratios. The first is the total debt ratio, which is basically long-term debt or total assets minus total equities. Remember, the balance sheet equation says that equity plus debt equals total assets divided by total assets. So this is debt as a percentage of total assets. And generally, and again this varies depending on the industry, we would like to see a ratio less than 50%. The next ratio, which is essentially all of these ratios, these three ratios I'm going to show you are basically equivalent. The next is the debt ratio, which is debt divided by equity. And if this is under 100%, then the debt ratio will be less than 50%. And finally, the equity multiplier, which is total assets divided by total equity, which is 1 plus the debt to equity ratio. Just algebraically works out that way. Next, we have the coverage ratios, which have to do with how efficiently we're using our assets. The first, times interest earned, we use EBIT, which is earnings before interest and taxes, or operating income, divided by interest. EBIT and interest are kind of next to each other on the income statement. Interest expense is right below EBIT. In this case, 4.9 times. I might mention that the TIE, or times interest earned, is one of the fundamental ratios that rating agencies use in assigning bond ratings to different corporate bonds, whether it's AAA, AA, single A, triple B, etc. The next is the cash coverage. We take the EBIT, or operating income, and add depreciation and divide that by interest. That's because depreciation is really a non-cash expense. This gives us a better idea of what we have. And then inventory ratios. First is the inventory turnover, which is cost of goods sold divided by inventory. Some books will use sales divided by inventory. I prefer cost of goods sold simply because cost of goods sold doesn't have the profit markups, and neither does inventory. So cost of goods sold and inventory are both on a cost basis, and it makes a better comparison. The next is the days sales in inventory, and you just take the inventory turnover and divide that into 365, and that tells us how many days of sales we have sitting in our inventory. Next is the receivables ratio. The first is the receivables turnover. This time we use sales, which has markups, divided by accounts receivable, which also has markups. So we use cost of goods sold and inventory. Now we use sales and accounts receivable. Tells us basically how many times our receivables turn over during the year, and if we divide that into 365, we see how many days of receivables we have outstanding. Days receivables outstanding, or days sales and receivables. Next, we have asset turnover ratios, more of these efficiency ratios. Take total sales and divide by total assets. Total asset, obviously we don't really turn over all of our assets every year. For instance, our property, plant, and equipment isn't turned over every year. So this is somewhat of a fiction, and the larger the amount of fixed assets we have, the lower this will be. Now we turn to our fourth category, profitability measures. The first is profit margin, which is net income divided by sales. Next is return on assets, which is net income divided by total assets. And the one that most investors are most concerned with is the return on equity, which is net income divided by total equity. Remember, total equity is equal to total assets minus debt. So from the balance sheet equation. The market value measures give us an indication of how expensive the firm is in the market. We would compare these with other firms, other similar firms, to see how this firm compares. The first is if we look at the market price, in this case the company is trading in the market at $88 per share. And there are 33 million shares outstanding. By the way, if we take the market price times the number of shares, we get the market cap of the company. So the PE ratio is the first of our valuation ratios, and it's the price per share divided by earnings per share. Some people like to take this a step further and take the PE ratio and divide it by the firm's growth rate and call that a PEG ratio. in this case 8 times. If you flip that upside down, what that says is that the firm is making about 12.5 cents for each dollar that you pay for it, each dollar of price. Then the market to book ratio, take the market value per share of $88 and divide by the book value per share. Remember, book value per share is equal to the equity on the balance sheet divided by the number of shares outstanding. In this case, 1.12. We now come to an important identity which helps us break down the return on equity and see its components. So we start with return on equity, which you will recall is net income divided by total equity. And just multiply it by 1, which will not change the basic equation, but will add some new variables. The 1 is going to be in the form of total assets divided by total assets. And we're going to rearrange. We're going to take the net income divided by total assets and the total assets divided by total equity. Remember, net income divided by total assets is return on assets, and the total assets divided by total equity is the equity multiplier. So now we see that the return on equity is the product of two things: how quickly our assets turn over and how much debt we have, or how we're using our leverage. We're going to multiply one more time, this time in the form of sales over sales. And we're going to rearrange the first of those two quantities in parentheses. We're going to take net income and divide by sales and divide by total assets. We'll leave the total assets divided by total equity alone. That will be the equity multiplier. And now we have the profit margin times the total asset turnover times the equity multiplier. So we now see that there are 3 components that make up the return on equity. The first is the profit margin. The second is how quickly inventory assets turn over, total asset turnover. And the third is the equity multiplier. Just to take a little aside here, if we thought about Walmart, Walmart has a fairly high return on equity, but they have a very low profit margin, which is consistent with Walmart's strategy of being a low-cost seller. But they make up for the low profit margin with a high turnover on assets and a fairly large amount of debt. And the reason they can safely use a lot of debt is that they have very low operating risk. They're geographically diversified and their product is diversified, and they're in some sense counter-cyclical. So when the economy turns down, people turn to Walmart. To use the DuPont identity, just again, the profit margin is a measure of the firm's operating efficiency, so the return on equity says how efficiently are we operating, how efficiently are we using our assets, and how much debt are we using in our capital structure. Those 3 things determine our return on equity. And just for the example in your book, the return on equity works out to be 14%. There's the profit margin, the total asset turnover. Using financial statements, ratios in and of themselves are numbers. They don't tell us much. They have to be compared with something. And we do 2 things with ratios. The first is trend analysis, where we look at which direction over time the ratio is headed. In order to make sense out of the trend, you have to have some notion of where good is. For example, Walmart, I said, has a low profit margin. We might be alarmed if we saw Walmart's profit margin rising over time, because Walmart's objective is to be the low-cost seller, and that means their goal is to have a low profit margin. We would like to see Walmart's profit margin be low and sort of either trend down or remain low. The next is a peer group analysis. We want to take these ratios and compare them with the ratios of other firms. And you can easily find ratios for other firms on the internet. I like to use Google Finance, but they're available in a number of places. Potential problems with ratios. First, there's no underlying theory, so it's very important that you have a conceptual notion of what the firm is trying to do. What are the strategic objectives of the firm? Again, I refer to Walmart. it's important to understand that their objective is to be a low-cost producer. Otherwise, we can't make sense out of the trend in profit margin. Benchmarking is very difficult, especially for diversified firms, because what are we going to compare a firm like General Electric, which has something like 15 or 16 different major operating divisions, each one the equivalent of an industry? What are we going to compare that with? What other companies shall we compare the ratios of General Electric with? So for diversified firms, conglomerates, very difficult. Globalization and internationalization make comparisons difficult because of the different accounting regulations. There is some movement underway globally to standardize the accounting process around the world. I don't know what stage that is, but there is talk of it. Firms themselves use varying accounting procedures, even domestically. So forget about globalization, forget about internationalization. Some firms use FIFO, some firms use LIFO, some firms recognize revenue immediately, some firms defer revenue recognition. There are all kinds of accounting procedures, and they're all generally accepted and allowed. Firms have different fiscal years, and firms that operate on different operating cycles and have different fiscal years make comparison of ratios very difficult. An individual firm's ratios, for instance, a toy company, the ratios will be much different in the summer than they are in the busy winter season. And extraordinary or one-time events make it difficult. And there are other reasons as well, other problems. Inflation is a well-known problem that causes potential problems with ratios. Now we'll talk about long-term financial planning. There are four major categories of long-term financial planning that we will deal with over the course of the semester. The first is investment in new assets. When should we buy an asset? When should we make the investment? And that's determined by capital budgeting. And we're going to start in about chapter 6, 7, 8, 9, those chapters. We're going to talk about capital budgeting. Then the degree of financial leverage determined by capital structure decisions, and we're going to talk about some of the theory surrounding capital structure in chapters 13, 14. Cash paid to shareholders or dividend policy we'll talk about in chapter 16. And liquidity requirements determined by net working capital we're going to talk about in the next chapter. So financial planning ingredients, if we were going to put together a financial forecast, the first thing we would do is get ourselves a sales forecast. Almost everything else we do will key off the sales forecast. A pro forma statement, pro forma means as if, and we're going to try to look ahead and see what the income statement and the balance sheet will look like in the future based on our assumptions, based on our objectives, our desires, our wishes, our strategy, those kinds of things. We're going to build all that in. The asset requirements, once we know how we're going to grow, we have our sales forecast and we put together our pro forma statements. We can see how big our asset accounts are going to be, and we can think about what kinds of assets we will have to put in place to meet those. Are we going to need more property, plant, and equipment? Are we going to need a bigger manufacturing facility? More delivery trucks or whatever. And then the financial requirements. All right, if we do need a new factory, where will we get the money, and how will we will we have debt? Will we have equity? Will we have bank borrowing? What, will we sell bonds? What will we do? And usually in our forecast there will be a plug variable depending. Something has to make the balance sheet balance. And that will be a default. Usually it's a lot of times it's equity, but it could be cash or some other account. And most financial planning makes certain assumptions about economics. And so we will have some standard economic assumptions that we use throughout the planning process. Most companies have an economist. The economist circulates the firm's official economic assumptions, and the various entities within the company that put together the financial plan are expected to make their assumptions consistent with the overall company assumptions. Talk a little bit about the percent of sales approach. This is a very simplified approach to forecasting external funding needs. Some items will vary with sales and others don't, first of all. In the income statement, if we think about an income statement, if costs vary directly with sales, then the profit margin will be consistent over time. If not, then the profit margin will change. It may be that depreciation and interest expenses will not vary directly with sales. In fact, interest expense is going to be more likely to vary with the capital budget, with the debt and equity that we assume, and depreciation is going to vary with the size of the property, plant, and equipment, the asset base that we're depreciating. And then dividends. Dividends are a management decision. There's no reason that the firm ever has to increase its dividends. The firm may increase them, it may decrease them, it may not pay them, it may make a one-time special dividend, but those things will affect the additions to retained earnings and therefore will affect our pro forma balance sheet. The balance sheet, we will initially assume that all assets, including the fixed assets, vary directly with sales. We'll also assume on the liability side that accounts payable vary directly with sales. We will typically assume that the notes payable, the long-term debt, and the equity generally don't vary with sales. Now, are we going to need new long-term debt and new equity? That may depend on how close we are to full capacity. If we have a lot of excess capacity, those items are probably fixed in the short term because we can continue to expand our operations. If we're right on the verge of running out of capacity, we may have to add new property, plant, equipment, and then we probably will need additional long-term debt, possibly notes payable. The change in retained earnings portion of equity is going to come from our dividend decision. Typically, when you're making these forecasts, typically, you assume that the dividend policy will remain constant. We talk about external funds needed. That's the difference between the forecasted increase in assets and the forecasted increase in liabilities and equity. Remember, the balance sheet has to balance. Assets have to equal liabilities and equity. So if the assets go up by 100 and the liabilities go up by, say, 50, liabilities and equity, then we're short $50. We need another 50 from either equity or debt to make the balance sheet balance, and those would be external funds needed. All right, we're going to talk about the percent of sales and external funds needed. So external funds needed can be calculated using the following formula. And I want to break this down into essentially three pieces. The first piece, I'd like to rearrange this a little bit. If you can picture the change in sales divided by sales, that would be the percent that sales are going to, let's say, increase. Let's say that sales increase by 10%. Then we see that assets will also increase by 10%. Now we're going to need money for those assets, so that's a required use of money. The next term is the spontaneous liabilities multiplied by the change in sales, and that's going to be a source of funds. If our liabilities go up by 10%, we've essentially been able to borrow 10% more from our liabilities. And the third part, that profit margin times projected sales, that tells us how much net income we're going to have. And if we take that and multiply it by 1 minus D, where D is the dividend payout, we will have essentially the retained earnings, which is another source of funds. So we have three parts. The first is a use, the second is a source, the third is a source. And the difference between all the requirements and all of the sources is external funds needed. External financing and growth, we're going to talk about how fast can the company grow. So at low levels of growth, internal financing, specifically retained earnings, may actually exceed the required investment in assets. We have a cash cow, we're generating money faster than we can actually find places to use it. On the other hand, if the growth rate is high, the internal financing may not be enough, and we're going to have to go out into the capital markets and borrow or sell new equity in order to get the funds we need to grow. Now, somewhere in between, growing very slow and growing very fast is a rate of growth that just allows us to use the retained earnings. And that's called the internal growth rate. So the internal growth rate tells us how fast we can grow using just retained earnings as the only source of financing. In other words, we're not going to go into the capital markets for either debt or equity. The equation ROA, return on assets, and B is basically the percentage of each dollar that we retain. In this case, we retain 66.7 cents of each dollar of net income. And the formula for the internal growth rate, and there is a problem in your book that discusses about the derivation of this formula. I'm not going to go through the derivation now. Take the return on assets times the plowback ratio, B is called the plowback ratio, divided by 1 minus return on assets times plowback. You can see in the case of Hoffman Company, the example we've been using, 9.65%. If we grow faster than 9.65%, retained earnings will not be sufficient to provide external funds. We will need external funds. The other growth rate we're going to talk about is the sustainable growth rate. Now, this is how fast we can go if we not only use our retained earnings, but we also maintain the same debt ratio that we have. So as we grow, our assets grow, so our debts grow. So if we use retained earnings and we let our debt grow, how fast can we grow? And this time it's almost the same formula, only instead of return on assets, we use return on equity. Same plowback. Basically, you could put ROA in there, you'd have the internal growth rate. Put ROE in there, you'll have the sustainable growth rate. You can see that if we allow ourselves to use debt, we can grow at a much faster rate, and that makes sense. What are the determinants of growth? Now, if you go back and think about the DuPont ratio, all of these will make perfect sense to you. Remember, the DuPont ratio had three components. The first was the profit margin. The second was the total asset turnover. The third was the financial leverage. And those three things gave us the return on equity. And then the fourth, so remember, the sustainable growth rate has return on equity and plowback, and so the fourth is the dividend policy, which determines the plowback. Some caveats. Financial planning models do not indicate which financial policies are the best. We're going to have a chapter or two where we talk about the theory of how much debt and equity a firm should have, what kind of financial policies the firm should pursue. Remember that models are simplifications of reality. And without some sort of plan, the firm will just drift. There's no direction provided, again, by ratios, and so we have to have some strategic plan in order to make sense out of what we're doing. All right, that completes the chapter. Let's go through this little quiz, and kind of mentally you can ask yourself if you are able to answer these questions. If you're not, I would recommend that you read the chapter again and go through the slides again, and then try this one more time. How do you standardize the balance sheet and the income statement? One of the first thing we talked about in the slides today. Why is standardization useful? We talked about a couple of reasons that standardization is useful. What are the major categories of financial ratios? We talked about 5 major categories. You should know what those are. How do you compute the ratios within each category? You should be familiar enough. You should get these in your head at least once. You should have them in your head. You may forget them, but I think one time you ought to have these committed to memory. What are some of the problems associated with financial statements and analysis? We went through a whole page, a slide here that talked about various problems. There are others I mentioned, including I mentioned inflation. as a possible problem. What's the purpose of long-range planning? Remember, we talked about 4 different categories of long-range planning, and what is the purpose of it? What are the major decision areas involved in developing a plan? Those were the 4 areas that I talked about. What's the percentage of sales approach? That's in its simplest form, that little formula that I gave you, and then I'll just give you this caveat one more time. Be careful with that formula. It only works as a black box to plug variables into if all of the assumptions are met. The firm's profit margin is consistent, the firm has excess capacity, all of the assets and liabilities that you're working with are spontaneous, those sorts of things. You need those assumptions for that formula to be realistic. What is the internal growth rate? We talked about 2 growth rates, internal growth rate and sustainable growth rate. At the very least, you should know what they are, what they mean, and how to calculate them. And the major determinants of growth. And we talked about 4. If you go back to the sustainable growth rate, it has return on equity and plowback. Return on equity, if you think about the DuPont model, has 3 ingredients, right? The profit margin, the total asset turnover, and the equity multiplier. And then we have the plowback, which has to do with the dividend policy. And that's it.